After the 2008 financial crisis, everybody thought they had it all figured out. Big banks, they were dinosaurs. The future was supposed to be smaller, simpler, more specialized. But what if one of the biggest players on the block looked at that playbook and just decided to do the exact opposite? Well, that's what we're diving into today. A huge contrarian bet that paid off big time.
So here's the landscape back then. On one side, you had pretty much everyone else. The thinking was, focus, pick a lane, be a great investment bank or be a great retail bank, but for goodness sake, don't try to be both. And on the other side, you had JPMorgan Chase, which basically said, no, we're going to double down on being everything to everyone. While its rivals were trimming down, JPMorgan was bulking up.
And this, right here, sets up a fantastic puzzle. In an age where everyone was screaming for specialization, how on earth did JP Morgan's bet on being a massive, complex, one-stop shop pay off so incredibly well? How did the supposed dinosaur not only survive, but completely dominate? Let's start with a number that's just hard to wrap your head around. We're talking about over $180 billion in annual revenue. It's a staggering figure that gives you a sense of the sheer scale we're dealing with. But, revenue is only one part of the picture.
Right, because it's not just about being big, it's about being profitable. And this chart says it all. This is a key metric, return on tangible common equity. Basically, how much profit you squeeze out of your business. And you can see it clear as day. At 22%, JP Morgan isn't just bigger than its more focused peers like Morgan Stanley and Goldman Sachs, it is way more profitable.
So, how did they pull this off? Well, it all comes back to a single, powerful idea they bet the entire firm on: the financial supermarket.
So what is a universal bank? It's pretty simple, really. It's a model that takes the everyday banking you and I do, checking accounts, mortgages, car loans, and sticks it under the same roof as the high-flying world of investment banking, things like advising on huge company mergers or trading complex securities. The idea is you can walk in and get literally any financial service you need.
And this philosophy has been the North Star for the firm's leadership for years. The core belief is that having all these businesses together doesn't make you clumsy, just the opposite. It builds a fortress, a diversified machine that can make money no matter which way the economic winds are blowing. Okay, a philosophy is one thing, but making it work is something else entirely. So let's get into the weeds and break down the 3 key strategic decisions that actually made this whole universal model tick. The first one was maybe the toughest. Right after the crisis, everyone, investors, regulators, politicians, was calling for big banks to be broken up. The pressure on JP Morgan to spin off its different parts was absolutely immense. And they just said no. And this slide really shows you the logic behind that no. The bank's 4 big divisions act like a natural hedge. Just look at 2023 and 24. Interest rates shot up, which was terrible for deal-making, so investment banking fees tanked. But for the regular consumer bank, those same high rates meant they were making a killing on loans. So when one part of the business zigs, another one zags. It smooths out those wild swings that a specialized bank just has to suffer through. Okay, decision number 2. This is where things get really clever. They didn't just want these businesses living next to each other. They wanted to build a powerful flywheel, a system where one part of the bank directly feeds clients and business to another, creating this incredible self-reinforcing cycle of growth. I love this slide because it shows you exactly how that works. It starts small. A medium-sized business just needs a basic loan. The commercial bank provides it. But as that company grows, JPM is right there, offering more and more services. And the relationship just gets deeper until one day that little company is ready to go public. And who do you think they're going to call to manage their IPO? The investment bank that's been there for them from the very beginning. All right, this brings us to the final strategic pillar. And honestly, this might be the most powerful. And it's this massive, almost secret weapon that they only have because they're a universal bank. So, what's the secret weapon? It's their deposit base. JP Morgan is sitting on something like $2.4 trillion in regular, everyday consumer deposits. For a bank, deposits are what you use for funding. And because these are just normal checking and savings accounts, it is an incredibly cheap source of money. A pure investment bank doesn't have that. They have to borrow money on the open market, which is way more expensive. This gives JP Morgan a massive structural cost advantage that basically fuels the entire operation. So we've talked strategy, we've talked philosophy, but does it all actually show up in the numbers? Oh yeah. The data really does prove this whole contrarian strategy was a brilliant move. I mean, just look at this. This is what total dominance looks like. Thanks to that flywheel, they're number one in global investment banking fees. But at the exact same time, thanks to their huge network of branches, they are also number one in U.S. retail deposits. They're winning in two completely different worlds at the same time. It's incredible. And you would think a beast this big must be inefficient, right? Bloated? Slow? Well, nope. This number is the efficiency ratio. It tells you how much a bank has to spend to make a buck, and a lower is better. At 51%, JPMorgan is actually run more efficiently than its supposedly leaner, more focused rivals. And here it is, the ultimate proof of the fortress strategy. Remember the regional banking crisis in 2023? People were panicking, pulling their money out of smaller banks. And where did all that money go? People ran to what they saw as the safest harbor in the storm. JPMorgan saw over $50 billion in new deposits come flooding in. In a crisis, their size wasn't a liability, it was their greatest strength. So it's pretty clear the model is crushing it today. They've built an absolute fortress. But the big question we have to ask is, will it last? Is this a model for the future or the past?
Because the world doesn't stand still. The threat today isn't another giant bank. It's an entire army of small, fast-moving fintech companies. Each one is designed to do just one thing, whether it's payments or lending or investing, and to do it incredibly well. And they're all taking little bites out of the most profitable parts of that financial supermarket.
Which leaves us with this final question, and it's one I want you to think about. Has JP Morgan proven that being the supermarket of finance is really the best business model out there? Or have they just proven that they are uniquely, maybe even impossibly, good at executing a model so complex it would probably crush anyone else who tried it? What do you think?